Good morning, everyone. So this, as Wallace has just said, this is the post-MPC meeting press conference. And I'll spend a bit of time discussing or presenting to you some of the background information and indeed the way the MPC members weighed various inputs into their decision. I'll also spend a bit of time in a particular area. Instead of going through every single thing at the same depth, I'll spend a bit more time on the external sector side, that's the balance of payments. And I think we should probably rotate the various sectors a little more, or the various areas, so that we can get incrementary, deep understanding as to what's happening in that area. So the first thing, as you all know, you did receive the press release, the communique from yesterday. And the first thing to note is that inflation remains well anchored. And for last month, the number was, at least the inflation number was 5.5% in October. And food inflation remains low, actually at about 0.9% in October. That's what it was. And one of the key drivers here is actually vegetable prices, or prices of vegetables are falling. There are other things that are also happening, but I thought it's good to flag some of the prices in our basket. The other thing which is worth noting here is that fuel inflation fell for the first time since July 2017. So it had been increasing, actually. It remains elevated, but it had been increasing, and it came down to 16.5% in October. Now, we know that our prices have been falling in the international markets, and we'll talk about that at a later point or towards the end of this presentation. Also, we know that now looking a little further into the future, there are prospects for lower fuel prices, and in this case, electricity prices. We know, for instance, the Garissa solar plant power was launched this month with 54.6 megawatt capacity, and that will be linked, if it has not already been linked into the grid, and therefore that is obviously something that is quite sustainable. And as we had said before, we had expected that the Lake Nakuru wind power would also be connected into the grid. Now, it's true, recently they did mention that they would be producing at 2/3 of the capacity they had announced before, that is 310 megawatts. So they would be producing at around 208 megawatts. And I'm not sure if they are yet connected, but that's something that we can check. Non-food, non-fuel remains stable. It remains low and stable, obviously pointing to the lack of, let's say, demand pressures. So the bottom line is that inflation is well anchored, and we remain in the target band looking forward. The second item I would want to flag to you is the growth outlook. And this is quite strong and favorable, and both for this quarter, indeed, for the rest of the year, 2018. We indicated that in the first half of 2018, growth, the economy grew at 6%. This is the real growth of 6%, compared to 4.7% in the same period, that's the first half of 2017. Now, this follows strong recovery in agriculture and resilient services sector. Now, it feels like it is way back when we first looked at these numbers, because these numbers have been with us since the end of September. That is soon after the last MPC meeting. Now, the leading indicators for that the MPC also looked at suggest a strong performance for Q3 in 2018, the quarter that ends in September. Agriculture, for instance, the recovery there is continuing, and I think we've all observed the very favorable weather conditions that we have had. Manufacturing also has posted good performance if you look at the indicators of the manufacturing sector, including, for instance, the electricity consumed by small enterprises that has increased, suggesting strong performance in the medium and small and medium, more micro, medium, and small enterprises, MSMEs. PMI indicators have also increased. It indicates increased activity or business activity. This is the PMI, which is an indicator of how things are going in the manufacturing sector, for instance, and so forth. Construction also appears to be posting a good performance, and we have looked at cement consumption and production, both of which have increased. And of course, the accommodation and restaurant sector. That too shows that tourism is growing very strongly. As a matter of fact, to October, the growth is something like the growth in tourism, or rather the growth rate of tourist arrivals is 17.7%. Just think of that, 17.7%. Of course, we know that we had a very low base in 2015 because of the security issues, but now we can see that the growth has strengthened, and indeed also, you may say that the capacity, meaning the number of hotels and hotel rooms in the country has actually increased quite well, or quite a bit in this year. I guess all of us can probably take a walk around Westlands, and you can see all those new hotels. And indeed, even here in the CBD, there are also various hotels. And that's just within the Nairobi environs. There are other places out there that actually have increased capacity quite well. Another thing I wanted to mention in terms of the growth outlook is the sentiments. And I think you are aware that we measure the sentiments using or in the context of our MPC survey. And that remains strong. The sentiments remain strong. You will recall that respondents to the MPC survey have been quite optimistic since January. And we do this every 2 months ahead of the MPC meeting. But in September 2018, their degree of optimism was much lower, was dented. And if you recall, September was an unusual month in that there was a lot of noise with respect to the finance bill that was being discussed in Parliament. And indeed, a particular element there was the VAT on, or the discussion around VAT on petroleum products. That somehow dented optimism, which has now rebounded. And now we are in the area of 91 to 93% of respondents expressing optimism, a degree of optimism from those that are extremely optimistic to those that are just optimistic. So, expressing a degree of optimism with regard to, or have favorable sentiments with regard to our economy. So what's the bottom line here? The bottom line is that there's a very favorable outlook for 2018, and we are currently holding our growth rate, projected growth rate for 2018 at 6.2, which is the same number we mentioned to you last time we met two months ago in September. But we will revise this as soon as we have the Q3 data, and we expect the Q3 data to come towards the end of December. So there is time to revise that maybe before we see you again in January. And I want to move to the other part, which is the one that I think I'll spend a lot more time on, which is on the balance of payments, or more generally, the external sector. We had reported last time that the current account deficit continues to narrow, and the foreign exchange market remains balanced. That is the case also now, and we are reporting the same. In particular, the current account deficit for the 12 months to September was measured at 5.3% of GDP, so a deficit of 5.3% of GDP. Now, this shows some contraction, and I just want to mention the drivers of this. First, agricultural exports. Tea is doing particularly well, and I'm told that the rains favor tea, but also the sun favors tea. So it rains, apparently now it rains in the night, and the sun comes on, shines in the morning, in the day. So that apparently is the best of all outcomes in terms of tea growing and tea production. And that has grown quite well. In the year to September, that has grown by about 8%. 8%. So the growth, and we are now talking not just volume, we are talking the value. The value of exports, tea exports have grown 8%. There are other things that are going on in the tea sector, or rather, in particular, searching for new markets and making sure that we can diversify a lot more, including China, including, other countries as well. So that is one thing. Agriculture, tea. The next one is horticulture. Horticulture also has grown by almost 20%, 19.8 to be precise. This is in the year to September, so 20%. And again, this is something that we can see is quite robust. And the other exports that have also increased, chemicals and also re-exports. So on the whole, total exports have grown in the year to September by 7.7%. Secondly, remittances have been doing very well. We talked about this before. We even explained why they've been doing well. And so far in 2018, that is from January through October, which is where the numbers that we have, all the way to October, we have already received 2 billion, or rather 2,234 million. That's million. 2,234 million US dollars in remittances. So we expect, if we receive, let's say, 300 million in the next 2 months, that is October and November, we'll have achieved our target, which is what we were projecting, our projection rather, of 2,531, 2,531 million. So we expect that remittances will be much larger than this number, than our projection. So they're doing well, and it appears that they'll continue to do well. As you all know, December is generally a strong month for remittances. That's when most of our relatives in the US and other jurisdictions will send their Christmas presents, will also send their let's say, the payments for school fees or whatever else it is, or that's when they come for Christmas. So December generally is stronger than most other months. So that is another element that has pushed or rather has contributed to the closing of the current account deficit. Then imports also have slowed, some of them, in particular food and machinery, food imports. I think we talked about this before. In the context of the drought last year, we ended up importing a lot of food, and that no longer is the case. So food imports have necessarily fallen, and so forth. So that we have already rehearsed. But this is against rising oil imports, and also I would say manufactured goods, but oil imports have have been increasing. And we talked about it. I mentioned it in passing, the fundamental thing here has not been so much volume, but rather the price. And as I mentioned before, the price of oil globally has been rising through to October. But we'll talk about what happens post-October. Maybe I should just jump into it now. Actually, the oil price dynamics have changed dramatically since the end of October. In one of the charts that you will receive, you'll see the average, monthly average, and also where the price is, where it was yesterday. And for us here in Kenya, our, let's say, benchmark product is Marban oil. And Marban oil is what? From UAE, a particular field in UAE, and particular quality or whatever else it is. Because you know they are like, it's like shirts. I mean, you don't just buy a shirt, you buy a shirt that is yours, right? So different sizes and things and different, content, of various impurities or other factors. So that's the benchmark oil that we actually use to understand how prices are moving or how they'll affect us. And it was the price of that of Marban oil was at $88.27 per barrel on October 4. And it has fallen to it fell to $59.95 per barrel on November 26. Okay. And actually, I need to check that. I think I gave you October 4. I think I should have said November 4, because all the action has taken place in the month of November. We can confirm that later. That's not a problem. But the point is that within a short period, the price of oil has fallen, and on the 26th of November, it fell through $60 a barrel. Actually, yesterday it fell a little more, and as of yesterday, it was $59.79 per barrel, $59.79 per barrel. This is a significant decline, significant. Actually, that's a third. So in this period, it has fallen in the numbers I gave you. That's a significant decline. Falling by 1/3, that's significant. But what are the reasons? What's going on behind the scenes here? There are 3 points I'd want to mention. First, the geopolitics. Now, I guess everything is geopolitics, but there are obviously, let's say, tensions or in terms of production by Saudi Arabia, and it's a large producer in the OPEC set of countries, and there are tensions there between them and the U.S. and the other players as well. But in terms of production, I guess the point here was that it was unclear how they would manage to produce continue to sell oil, but I think those sentiments have improved. Then there's the concern about headwinds in the global economy. So you could think of demand not being very strong looking forward. So you have things like the trade wars that we are talking about, the decoupling. We'll talk a bit more about this in a minute. So the concern that the global economy is getting weaker than was expected would actually cool off the expected demand, and therefore work towards lowering the price. Then there's a third element, which is the U.S. production of shale oil. And that apparently is much stronger than was earlier predicted or expected. And clearly the U.S. is a large consumer of oil, and if it is producing its own oil, well, that will dent overall demand from, say, OPEC and other players. So those are the dynamics that have served to bring down the price of oil quickly. It's clear that many of those will remain with us for some time. Sure, some of them we hope will be resolved. Our hope is that the trade wars kind of end quickly. There's some sort of, let's say, abandonment of the war. Thank you. Well, thank you. So I've just been told that the 88.27 was on October 4, which is what I mentioned, and I should have stuck to my guns, 88.27. But it's good to also, if you are not sure about something, it's good to say it. And I think it's fine. We can always correct things if we make a mistake. So, fine. Wallace is not my lawyer, by the way. If you think he's going to be my lawyer, no such luck. Thank you, Wallace. Okay, so that is the dynamics in terms of oil, or rather the oil price dynamics that will be with us for some time. Now, still on the external sector, I need to talk a little more about the global markets out there. What has happened is things are getting more and more complicated. I'm now talking about the global markets. Kenya, of course, is set within, let's say, a constellation of markets around the world and constellation of countries around the world. So we are not, and as somebody said, no one is an island, to themselves. So we have, things are getting more complicated in the global markets. And recently there were jitters, or rather jitters have returned into the markets. Now what happens is occasionally we report on, ourselves in this room, quite often the headline numbers that we report are what has happened in the stock markets out there, whether let's say the New York stock market or the Chicago, the Chicago market and all those other markets, the London market, all this, and the key, let's say, indicators of those, that they've moved up, they moved down, turnover in those markets. But that's not really where the action was. The action was more on volatility. And last week we had a special dose of volatility. That has been with us. And the question is, there has been discussions about the return of volatility in our markets. If you could unwind to, let's say, back in 2013, when the US announced that it was going to taper its purchase program, purchase of securities in the context of its QE maneuvers or unconventional monetary policies. The markets then actually got seized by jitters, and there was turbulence in the global financial markets. Subsequently, we have called those the taper tantrums of 2013. The point I want to make is that what actually we are seeing now are those sort of jitters because of serious uncertainties that have set into the markets. The uncertainties, and for instance, you can measure the volatility in some of these markets, not so much because, so you could think of a lot of volatility during the trading day, and then the price ends, the end price or end index is still, let's say, the same or hasn't moved much. But there was volatility during the day. And that in itself is a problem. So measures of volatility, for instance, the VIX, VIX in the various markets, have shown that and the other indicators. But I just want to mention, I want to direct you to something that we have not been looking at that closely. Now, the concerns also have been because of the escalation in trade wars. And now we are talking about the US and China, that sort of tiff between them. By the way, it's still a skirmish. It's not truly a trade war. It's not really open out war. if nobody blinks, we'll get there. And we all know that every one of us will lose. Every one of us. Not only China, not only the US, but all of us will end up losing. There are no winners when it comes to trade wars. So those are concerns because I guess the markets were expecting that everybody will see that it is damaging to all our economies, and therefore there'll be, let's say, a diplomatic solution to an economic problem. Maybe it was always a diplomatic problem, but that's not for me to judge. Then another element that has been dragging the global markets is the sort of, the drag in the economies themselves, meaning there's now a prospect that the world economy may be cooling off. It's true the US is still doing very well on its own, but things are not all that clear. And actually, even in the US, there's some numbers that came out recently that indicate that are not that positive. So there is a sense that the global economy may be actually cooling much more than was expected. Add to this the decoupling of the various economies, the advanced economies versus the emerging markets, and indeed, even within the advanced economies, the US versus the other advanced economies. So those are the things that are going on. There's a lot of hope in those of us that monitor the global economies that this weekend there'll be a beginning of sort of corporate or cooperative solution, because this weekend they'll be having a meeting of the G20, and that they could discuss, particularly the warring partners, the US, China, and come out with a solution that is beneficial to all of us. There's a final element, and I'm sorry if I'm being a bit excessive here, but again, as I said, it's important for us to deal with some of this issue in some detail, and today we have chosen this area. There's also some more uncertainty about the US Fed's action. They will be meeting in December, and the question is, the expectation was, since the US Fed had already, let's say, given forward guidance that they would actually be raising rates a fourth time. But given the numbers now and given the statements by the US president, it's unclear which way the Fed will go. So in that sense, this uncertainty of the Fed's action, it's true, it's not that they need to always be completely certain, but the other dynamics that are surrounding the decision, and the markets cannot interpret that sort of fog around that decision. So that is why the jitters have come back, and that's why the global economy, the various other indicators that you've been seeing, particularly from emerging markets, have ended up being negative. It also bears mentioning that the one positive element in all this is the decline in oil prices. That has benefited a lot of the emerging markets, and therefore I don't want to say there are problems, but the emergency of difficulties has been delayed. And in a sense, you could say it has given the policymakers around the world more breathing space for them to put in place measures instead of how things would have been if oil prices have remained where they were, say, at the beginning of October. Okay, so those are the details in terms of the dynamics. Let me balanced, very balanced. And this reserves, as we had explained to you last time, remain adequate for in terms of our cover. We expect the current account deficit for the year to narrow to 5.2% of GDP, 5.2% of GDP. This compares to 6.2% of GDP in 2017. And actually, if you look at your notes from September, we had given you a number like 5.4. That is what we had projected then, 5.4% of GDP for the year 2018. But we have revised this marginally to 5.2. Bottom line, this is, it's closing as expected, and we don't have any concerns at all about this. I'll then move on to other things that will probably be, maybe now, yeah, this is on something else that I think we need to talk about, which is again on the balance of payments in external sector. There has been a lot of discussion by some of you about our assessment of our exchange rate and exchange rate policy. And we have said that in our own calculations support the view that there is no fundamental misalignment reflected in our exchange rate. And we have also reiterated that the Kenya shilling reflects the currency's true value, the true fundamental value. We've mentioned that before. We've also explained to you what our exchange rate policy is. And just to repeat it, we have a flexible exchange rate regime, and we don't have a view about the level or the direction of movement. It can weaken, it can strengthen, it could depreciate, it could appreciate. So we don't have a view about any of that. So flexible. We let the market flexibly drive the price on the shilling, or the price of foreign currency, if you may, conversely. The only thing we do is to intervene in order to minimize volatility. So we have a flexible exchange rate regime where we intervene only to minimize the volatility in the market. And that is well understood. It's well understood by practitioners and every single central bank, and I guess every single bank. And now I'm not talking just about Kenya, I'm talking globally, that volatility volatility in the FX market can actually be destabilizing, both in the financial sector, but also other areas in the market. So that is really our exchange rate policy. Now, the question again is the assessment on how do we calculate this, our calculation. Now, this part will be a bit technical, so maybe it will show that I went to school. I don't know. But I think I'll move quickly, okay, through it, so the pain won't be too long. The point is we use standard approaches, okay? This is something that has been done repeatedly. It didn't start yesterday. And we use several approaches which have been used by many countries and quite well known. I mean, we use, for instance, the PPP approach, we use elasticities approach, we use behavioral equilibrium exchange rate approach, otherwise known as beer, like the stuff you drink. We use the macro balance approach, and all these approaches, you could say it's a whole, let's say, range of approaches. There's not a single approach that does the job, right? Just when you go to your doctor and he wants to know whether you're okay, he doesn't just measure your temperature and tell you you're okay. As a matter of fact, if you measured my temperature and you didn't see that I'm like 200 kilos big, my temperature will be okay, but I have a problem, right? So you need to use many techniques in this way. And that's the technical part. That's the part that it's technical, but it's well known and well rehearsed in terms of, so there's little to misunderstand. That said, it's also important to note that unlike, say, the temperature, when the doctor checks my temperature and says, okay, fine, this is about normal, whatever it is, right? There is actually a sort of a judgment element. So it isn't just the numbers coming out and then you look at the numbers and say, okay, this is okay. There is an element because there's an element of judgment because there are other factors that come in. For instance, if we know, for instance, that there are other policies that have been put in place, and here, for instance, you know that we are having a consolidation, fiscal consolidation. So that will necessarily have an impact on the current account and also more broadly on demand on FX. We also know other things that are strengthening our competitiveness. You know, the other measures, for instance, the price of electricity is coming down. For instance, the transportation is improving because of the new infrastructure investments. These are all considerations that the researcher or the analyst need to weigh in before saying whether or not the exchange rate is misaligned. So we did all that, and we have calculated, and I have mentioned this before, all our estimates show that the extent of any misalignment is less than 5%. And as I told you also before, in terms of, judgment, anything less than 10%, you know it will be closed by other factors, the ones I mentioned. And this is what led to the judgment that I mentioned a moment ago. That said, we will put together our analysis and put it on our website, and then you can look at it. Let's see if it is exciting enough to read. I know Professor will read it, but I don't know whether everyone else will read it. So that is the way we came up to that. So what is the excitement about? The excitement is because the IMF did actually put out a document that said that that indicated that or suggested that our exchange rate was misaligned by a particular magnitude. Now, I don't want to go sort of into too much let's say, technical things on that side, but I want to mention a few things. First, they used a new methodology. A new methodology that has only been put in place since it was launched in 2015. And actually, if you want to look at it, there's a methodology paper that was published in February of 2016. It's a very new methodology. Actually, the methodology, it's called, in the jargon, it's called EBA. So the EBA methodology was designed more for the advanced economies. And now it's sort of been brought down to the non-advanced economies. That's not a turn of phrase, but let's leave it there. So the economies that are not advanced, right? Now, it's well known, the problems with that maneuver are well known and well documented. So even as you bring it down to other countries, it's fine. You can test it, you can use it. But the underlying thing is you need to be careful of the weaknesses of the methodology, which are known and well rehearsed. And I quote here, model estimates are intended to help inform the analysts. At the bottom, as the bottom line will always involve judgment, using our information. That is what staff were meant to do. However, what happened is, and I don't know why, I don't think mine is to ask why. Ours is to, and you can refer to whatever it is, right? The point here is that it was used in a sort of a black box environment. So it was a black box, data went in, whatever popped out was what was presented. Obviously, that's something that we would not agree with. And I would ask you, how many other countries have used this methodology? I'm talking of countries that are closer to us, meaning our peer countries, not China, not Korea, and all these other things. And the answer are very few. So in a sense, we are the ones that are being used as a guinea pig in terms of the IBA-light methodology. That's something, obviously, that we don't agree with. So I'll leave it there and tell you that there is actually a whole technical discussion that would surround that. But in the interest of your listeners and viewers, we'll move on. A couple of other things I want to mention. Yes, the fiscal program you know the deficit target that has been announced and which points to some consolidation, and the issue now, of course, is implementation of that plan and performance against those targets. The one thing that I need to, in all this, that I need to mention is the continued performance of our borrowing program. As you know, we have to support the government fiscal needs, meaning borrowing, financing, through, let's say, selling, as we are the agent, we are the government, we are the agent in terms of new bonds, new treasury bills, and things like that. So there was a recent bond that was issued. This was way back in, sometime in mid-November, around November. The value was November 19th. And I wanted to mention a few things about this, but again, it's the backdrop that the borrowing program is moving along as expected. If you actually draw a straight line from beginning to end, you will probably not be on that straight line because there's a sort of variation. But in terms of where we want to be, we are comfortable that the direction or where we are today is okay. But anyway, so the last bond actually was interesting for various reasons, and this is why I want to flag it to you, but I think suffices to say that the bond program is also going well. And it was interesting for several reasons. One, it was the first infrastructure bond that we have issued this year, okay? And the infrastructure bond is tailored to financing of specific infrastructure projects in the country, meaning in the government's budget. It's also different in that you have some sort of tax advantage, tax incentive, and it generally is very popular. So there are several things that I think we need to appreciate a little more. First is that this bond, infrastructure bond, is the first time we issued it, or rather we advertised it at 50 billion. That was the size, 50 billion. And we've never done this before. You know, the highest we've had was always 40. So there we go at 50, okay? And actually, the amount that was received was 40.39. So you can see that, fine, maybe we raised the bar in terms of size, but the outcome, even though the performance, if you divide 40.39 to 50, you get 80.8. That performance is actually not shabby at all. On the contrary, bearing in mind that you've raised the target, it's actually quite favorable. That is one thing you need to appreciate. Secondly, it is the first infrastructure bond at 20 years. 20 years. All the others are in the range of, let's say, 7 to 15. So this was actually quite, attest the market. And rather than say that we didn't get 50, therefore it is a problem, actually, this was quite favorable, bearing in mind the length, right? Bearing in mind that this is a long-term bond. We are not talking 5 years, we're not talking 10, we're not talking 15, we're talking 20 years. That is something that also needs to be appreciated more. Thirdly, it's true when you have infrastructure bonds, you cannot put them on the same yield curve as the let's say, infrastructure bonds. You can actually say that infrastructure bonds have their own yield curve, but you're not going to create a yield curve for the infrastructure bonds. Otherwise, you have to have, anyway, maybe in due time, maybe our kids will do that. But for now, we are okay with one yield curve. The point is that the pricing was also ended up, meaning the demand and the pricing by the market was also quite appropriate. It's hard to say favorable because, I don't know, is it for the issuer or for the investor? But in a sense, if you look at the yield curve and also see how, what margin you want to, if you use that term, you have around that, it was something that you could say was appropriate. So bottom line, yes, there has been good performance on the bond finance, and we expect that that will continue. And in effect, from our perspective, we need to be moving more to bonds so as to increase the maturity, rather term, so time to maturity, the average term for the government securities. So that's all I want to say about that. I want to finish. I'm sorry I've taken too much time, but before I finish, well, maybe 2 points before I finish. In terms of Imperial Bank, yes, we are working with KCB that had presented to us an offer, and we're still working around that offer. It's hard to put it in any other way except that it is really that offer that we are working with, and we do hope to close soon on that offer. I think I'll stop there and take your questions.
Thank you. Duncan from Reuters. Sorry, I have a few questions. We don't get a chance to interact. We don't get a chance to interact with the governor, so sometimes we'll stock up on questions and ask them at this forum. First of all, in your statement yesterday, you said there's evidence that the rate cap is interfering with transmission of the policy signaling. Could you be a little bit more specific? What kind of delay are we seeing there? And also, would you comment around the other tools that are available to you as policymakers in the context of the rate cap? We know you use the CBR, but there are also tools in there like the cash ratio for banks and that sort of thing. Would you give us a comment around whether those can then come in to do the job that you're not able to do effectively with the rate cap? And then off the back of the N1 issue, banks complained that whenever they report suspicious transactions, the FRC doesn't do much. Thank you.
Yes, my name is Oteto Guguyu from The Standard. About tea, could you give us a comment? Because you raised, in the market survey, the central bank raised something about impact of the Iranian sanctions on tea, probably export. Could you tell us if...
Sorry, say that again?
In the survey, you'd raised something about the impact of the Iranian sanctions on tea, because it was one of our markets, so I don't know if it has had any impact so far. And then, given that the oil prices have fallen, do you think that the Treasury will have something? It will affect the fiscal consolidation, given the expected receipts will be kind of lower from the VAT. So, do you think that will have some pressures on the fiscal consolidation by Treasury? And then, lastly, okay.
Faisal Ahmed from Citizen TV. One question. Maybe if you could give us an update on the new currency.
Good morning. Jimmy Mbogo from K24. And my question is, should we be concerned about the stability of the shilling, given that we only have 5 months worth of reserves?
Okay. So let's begin with Duncan's question about the rate caps. There is a paper that we have already put out on our website, and it talks a lot about these things. what the MPC received is, let's say, a re-estimation, right? Because we got 2 more months of data. So the question is, does the data, the new data, does it, let's say, weaken the statements that were already with us in September and that have been publicly put out on our website? That was really the question. And the answer was no. On the contrary, actually those factors remained quite in evidence. And the factors relate to, and I'm now not going to have an entire list, that first, the policy actions are delayed. So it takes longer so it's a bit like you're driving a car with very low horsepower. So you push on it and it takes some time for it to get the oomph to accelerate or whatever else it is. So yes, it's taking longer. Secondly, the impact is smaller. So what would have been X is now, let's say, a fraction of X. Thirdly, there is the issue of remember, it takes time to, as I said, it takes time to get its full effect. It actually, as it goes on, it produces a perverse reaction. And we looked at it from the perspective of even classification of banks. So large, medium, and small banks, and looked at the individual. So you think of a panel that involves 3 groups. And that also shows that you do have, particularly from the large banks, a strong perverseness in the reaction. So Duncan, that's really what I would want to say. So there isn't anything, and frankly, we need to be testing it because remember we said that we are data-driven. We are a data-driven central bank. We have our priors, we are economists, but at the end of the day, we also need to test and confirm whether those priors are there. And the issue here is absolutely clear, crystal clear, that the problems that we had flagged have actually come to pass. So that's the first question. You did ask, well, do we have other tools like cash? Remember cash ratios and reserve requirements and things like that. Remember, those are blunt instruments as well. And they are instruments that you don't, let's say, tamper with every day. Because they are embedded in the business models of each bank. So in a sense, those other instruments will only use them in those sort of extreme occasions. At this moment, yes, we've said that the market remains liquid. I could have talked a bit more at the banking sector. And actually, to be clear, it's true, liquidity ratio in the system has increased. In terms of capital ratios, that also has increased. Their numbers are in the press statement. And one of the things that we've also seen is the reduction in NPLs. So all that is, the point here is that we see the banks are doing the right thing in that area. And we obviously do not want to in any way destabilize it. So we need to go back to let's say, the workhorse of the instruments. And again, as I said, there's a sort of a waterfall in terms of the instruments that central bank uses. There was a question about FRC. You see, I cannot talk much about what banks complained about or not. That's probably not something that I would entertain, complaints. People have to act. But that said, what is clear is that the FRC needs to be strengthened even more. That is not something that is news to any of us. For instance, just recently it was converted to a sort of a standalone state corporation. They are now hiring, and they've been doing that. And so they are moving towards strengthening themselves. Obviously, other institutions support them in particular ways. But at the end of the day, FRC does need to be stronger. And that is something that all of us would agree. Even the banks and yourselves and ourselves would agree that that is something to do. Gunyunyu asked about the impact of the sanctions on Iran, and particularly with regard to tea. The point is that the sanctions exempt agricultural products, and this is our understanding. And so those were, in a sense, excluded from the sanctions. So the impact on that would be zero. But the point for us is, even as we have Iran and other countries, Egypt, Pakistan, we do need to diversify a lot more. And the point here is not so much that we are afraid that one destination may have problems and therefore we need to have an alternative. No, it's not that. I think even in terms of growing the volume, and having a bigger base for our tea. And our tea and other products, actually, they do demand a certain premium above other teas. So I think it stands to reason that we would do that. Oil price and the impact on fiscal consolidation, we could have this discussion, but I don't know. I think the way I would look at it is there are other factors, right? Oil price generally, remember at one point we talked about in the negative, when we were thinking of oil prices going up to, and some of you had told me, what happens when it goes to 100? And my view then was, look, if it goes up by that amount, all bets are off. Those are my words. All bets are off, meaning the global economy will go down like a stone. And you'll hear it, grinding to a halt like a broken machine. And then at that point, it isn't these sort of issues or marginal issues of, where you are on X or Y. I mean, you have fundamental issues to deal with. So my point is, now we have the other side of it. The fact that oil prices are falling will actually be beneficial in many ways, in terms of even pricing of our products. Think of manufacturing, for instance. We also know, for instance, there is still some of our pricing of electricity is also related to some of this oil prices. I think we had this discussion some time ago when the rains came, not beating on us, but the rains came, and still the price of the price of electricity was high. You remember that whole saga. So before we get to fiscal consolidation, there's a whole other bunch of things which would affect fiscal consolidation. If the economy began to sag, that ipso facto will affect or will, in effect, call to question the consolidation that is there. So there are other factors, and I wouldn't want to pick on just the one direct link, which is the price and taxation, VAT on that, and whatever else it is. That, I think, is a mechanical issue, or just pulling a calculator and calculating. But I think the point for us is there are other factors that need to be dealt with. Faizo asked about the new currency update. Yes, I can update to you that we were held back by some legal challenge. And in fact, on October 12th, we issued a press statement. October 12th, you have seen it, that said that we had got judgment by the Court of Appeal on certain elements relating to the issuance of the new generation banknotes. And we did note in that press release that together with the previous judgments, that judgment on October 12th confirmed that there was no proof of collusion between the CBK and the successful bidder, and therefore we were clear to proceed as we would. And at the end, we did say that we will proceed with all due haste. That was what we said. So I can only tell you that we are proceeding with all due haste. and we will communicate to you and others when we are ready to tell you where we are on the next step. So we are in business. There was a question about the stability of the shilling, and the question was, should we have any concerns if, because we only have, 5 months of imports covered? I'll put it differently. You know, when we had this discussion, I think we had, in September, we went through the discussion about adequacy of reserves. I don't want to repeat that, and we used many measures. So it isn't just one measure. But that, be that as it may, frankly, when we were, a rule of thumb, when you begin to worry about things, is 3 months of imports. That's a general rule of thumb. It's not precise. But the point is 5 months is quite, is well within the, we are still within the regular time. I mean, the game is still far from over. I hope that's an analogy that some of us would appreciate. I see my friend here is wearing an Oakland shirt, so he probably doesn't appreciate that. Okay, what other questions?
Thank you very much, Governor, for your time. I have a question relating to infrastructure bonds.
Yes, please.
One of the things that the Finance Act of 2018 did was to widen the purview of the definition of a dividend. And I'll read it where it says, where a dividend is distributed out of gains or profits on which no tax was levied. The company distributing the dividend shall have a tax now in the year of income. Consider a fund manager who invests in an infrastructure bond, which ideally should be tax-free, but out of the proceeds distributes to investors who now will be subject to the dividend consideration in terms of the impact on taxation. Should this be a point of concern for us in terms of what this would mean for appetite for infrastructure bonds? Then my second and last bit was, one of the proposals around the IMF was more transparency from the central bank in terms of intervention. You spoke about intervening just to smooth out volatility. What's your comment on that, please?
Okay.
My name is Patrick Alishula from Business Daily. I have a question around the NYS. Last time you talked about having started the second phase of your investigation. Could you please give us an update on that? Then number two, we have seen some easing of the NPLs. What contributed to this? And I'm asking this with special interest on what has happened with government payments. Has there been any sort of improvement and any number around that? Then on card payments, we've seen the use of card payments increasing. What could be behind this? Thank you.
Do you want me to take this? Or?
Morning. I have one question. I'm Victor Madala from the Star newspaper.
Victor.
Yes.
Okay.
It is afternoon though. Okay. It is in regards to the Imperial Bank depositors. They've really complained that you are keeping them in dark in regards to the transaction with the KCB. Maybe are you informing them on the steps, or maybe where you are at? Thanks.
Thank you. Thank you all for these questions. First, in terms of the tax question, I'm not very good at legal issues, so I would punt that one and deal with it later, because the point is that there is a way the laws need to interact. And also, maybe a fund manager, when they invest, they may be investing on behalf of somebody else, but it's clear from the beginning that it's on behalf of somebody else. So I don't know how those laws work. I would only be guessing. So I wouldn't want to answer. So please, let's deal with it separately. Second issue was the one about statement about more transparency on the central bank with regard to intervention. I presume it is intervention in the FX market, but it could also be intervention in the money market or whatever else it is. I don't know. A second, please. So I'm sorry, I got distracted, but the question is, should we be more transparent and all that? I think the transparency is within certain limits is appropriate. There's no doubt about that. But I think the point here is, the first question I need to ask is, what is being bothered by the current system? And are we intransparent in the current system? Because I would argue and say the answer is no. See, this is the issue. We quarrel with the IMF. Let's be clear, just like we quarrel here, right? We may not agree on everything. So whatever they put out there, please also challenge it. What is it? What is it that they're trying to do in this thing? So our point is, and I'll just tell you what our view is on this. We actually do not comment on details of FX interventions until we judge that that information is no longer market sensitive. That is important to understand. It's no longer market sensitive. And this is in keeping with practices of other central banks around the world. I would challenge you to tell me whether the central bank of, the Bank of England, for instance, you didn't know I was going to throw that at you. Just go and check how much they reveal. Now, it's easier to just bash us, right? Because you're Central Bank of Kenya, you know, and maybe through this black box, whatever it is. But the point is, we are holding on to a certain particular policy, which we believe is appropriate given the experiences around the world and given our risks. You know, we are extremely open, extremely open. We don't have any controls on the current account. We don't have any controls on the capital account. Very open. We cannot just take things, you know, for granted. Just for the sake of transparency, we put it out there. It doesn't work that way. We have to be concerned about financial stability. And that is in our act, right? That is right there in our act. So that is really the judgment of the central bank. So I hope I've explained to you how we get to that judgment. But surely we don't do it in a vacuum. When we intervene, of course the banks know we're intervening. So when you say transparency, is, you know, if we are intervening by selling to our favorite state oil company, you understand what I'm getting at? Or selling to our favorite commercial banker in the dark of night. That's another matter altogether. So let's be clear about it. In terms of operations, it is very clear how we do it. Every single institution that is involved in that market knows and are fully aware of the details. And when we judge that the thing is no longer market sensitive, then we will deal with it. But we cannot recklessly just reveal information for just so as to, to say that we are more transparent. It doesn't make sense. I hope I've clarified that. NYS2 update. I think you already know what we have done. You already know that we have concluded the discussions with the various banks. We put out a rather detailed press release that explained what is it that we had done, and in particular about the plans. That was the much more fundamental thing, the plans of the banks to strengthen their AML CFT frameworks. That was key. And we have done very well with them. And you can see, and as we explained to the world in our press release, that they are committed to having a much stronger framework for anti-money laundering CFT. So that's what I would say now. Well, obviously, it's not completely done. There are other things on the side that also need to be tightened, but we are working well on that. And then we'll see other things that are coming. We need to balance things as well. We only have so many staff members. And so in a sense, it's work in progress. I hope you can appreciate that it's work in progress. NPLs, I'm not sure I agree. I don't know who asked about NPLs. I'm not sure I agree with the, maybe I misheard you. NPLs actually have fallen, not increased, in terms of ratios. And actually, it has fallen, NPLs as percentage of gross loans have fallen from 12.9% in August to 12.3% in October. And this is really as a consequence of the recovery efforts that the banks have been doing. And this, I think, is laudable. Now, the question, I think, was directed more to the concerns about NPLs relating to late payments and things like that. And we were actually one of the first to make this point, that this is a concern for the economy, that suppliers are not being paid on time. And it wasn't just the government at that time that was, let's say, the only one that was not paying on time. Actually, private sector entities also were paying late. And the delay had gone from, let's say, 3 months to 6 and then 9 months, which is really amazing, or rather something that is really worrisome. So our view here is that all parties need to work together. And frankly, just as an example, you can think through the impact of, say, Uchumi or Nakumat being unable to pay its suppliers. So there's a whole, let's say, in second-order effects on all the other suppliers in the chain, and that is significant. So those are the sort of, that is what is resulting to the NPLs that we mentioned. But the more the banks work on it, the better it will be for the economy. And obviously, we want those that, let's say at the beginning, the ones that are much more central, the government and indeed the others, to resolve these NPL late payment issues. Card payments, I wasn't sure what you're saying about card payments, but I don't think I have a problem with the method of payment as cards. It's not, I mean, cards should be quite secure. It's true there's card fraud, just like you have pickpockets around, but pickpockets are not going to stop me from, carrying money. I have to be more secure. I have to, put my money in a place where it's well protected. But I think the point is, unless I misunderstood you, I don't think the issue for us is one of, minimizing card payments and things. But maybe I misunderstood the question. IBL depositors, I think in a sense, and I've made this point to them and yourselves before, it's true, it's the issue of explaining to them where things are. That is important. But what I think we need to be more appreciative of is having a discussion that is premature doesn't help anybody. Doesn't help them, doesn't help us, doesn't help KCB. So that is what we are struggling with. It goes back to the issue of transparency. We can be very transparent, but if we become so transparent as to weaken the final deal, at the end of the day, what is most important is the final deal. That is key. But if, in a sense, we jeopardize that final deal, I don't think we are serving the depositors. So it's really an issue of focusing as to what is it that we need to do, we are doing. And here we are working for the depositors. I have repeated that, and we continue to repeat that we are working for for them, to maximize their value. I think those were the questions I had.
Perhaps one last round. So we didn't add like a second plan at all. Back to you again. Is there anyone else? So about 5 people.
Okay. One is just a clarification. IMF, I think, put forward two models. One gave them 17.5, another one gave them 18. So I just wanted to know if both of the models were unconventional, both of them, just the rear and the EBA one. And then for the second question is, Governor, as you approach the last leg of your first term, what do you think are some of the hallmarks of your legacy, and do you have any regrets over this period? Thank you.
It's too early for that question.
Yaenda.
It's June next year. It's only November now.
Hello, my name is Adelaide Chongole. I only have two questions. My first question is on the follow-up on what the gentleman from Reuters had asked about perverseness. And I was curious, you have said that the perverseness gets worse and it's becoming more evident with the tier one banks. And I was wondering how exactly is it manifesting, and when did the central bank notice the first effects of this? And the second one is on new products. There's some banks which are saying that it's taking a long time to get products approved by the central bank. I'm curious, are there any new guidelines that you have put forward that is now slowing down the process, or is this just the banks being finicky? Thank you.
Okay. Anyone else?
Yeah.
Okay.
Mine is on the follow-up, still on the currency.
Go ahead.
Yeah, given the fact that we have a 4-year delay from when the procurement process started with the printer, what sort of urgency are you putting towards this particular issue of printing of the new currency, given that it's still a requirement of the Constitution, and we were supposed to do this back in 2014, I think?
All right, Bwana Governor, I would like you to talk to us about the status of the money supply in the economy, as well as what the CBK considers to be the biggest threat to Kenya's economy.
Yeah, just one question. We've seen banks sort of tweak their business model to sort of put more focus on digital lending, offering their services and products on mobile phones and that kind of thing. Any comments around that as the regulator? Thanks.
Wow. I think that's it. It is becoming. I'm delighted that you're becoming more economists. The questions are more in that area, which is good. If I had my way, we would all be economists. But that would be a terrible world. Well, okay, fine. So let's begin with the first one. Please read the document again. Let me not, I was training not to be judgmental. I was training not to be. And I don't want to drop into that territory. When I drop into that territory, to be in a closed room with them. So please, it's there, they put it out. You can struggle through it, that's fine. If you want to come and have a discussion about it, fine. But I think the point I'm making is don't drag me into that. I feel very uncomfortable going into that. You asked about legacy. I have no clue what that means, because we are hapa ni kazi tu. So, Adelaide asked about perverseness, how is it manifesting itself? I guess just as we have been saying, this is something that when we started off, we didn't have data. I guess it goes back to the issue of what is our approach to things. And I hope by now I have convinced you that we are very much a data-driven institution. So we make our policies based on data, actual data, not on political expediencies or, seat of the pants or whatever other expression that one would think of. So even though as economists and as policymakers, we had a view as to what would happen, we have been using more data. We've been using the data that is being generated and an expanding wealth of data. And that's what we are using. So if you ask me when did it start, I would say right at the beginning. The moment the interest rate caps were put in place, that's when the perverseness was introduced. However, in terms of testing and confirming it in a rigorous statistical manner, that you can only do once you have enough data. And as you would know as a statistician, or as a statistician would say, the more data you have, the more robust your conclusions could be. If you only have a few months of data, whatever you get will probably not be robust. Okay, so that is what we've been doing. So there isn't a sense that the first year there was no perverseness, it's the second year when the perverseness kicked in. The perverseness kicked in from day one, from September 14th, 2016. So that's when the perverseness kicked in, but it has been reviewed to us only gradually. So that's what I would want to say about that. New products, well, I meet commercial banks regularly. It would be good to know what this is, because this is the first time I've had that complaint. There are complaints about other things, but I've never had that complaint before. So they have their communication with me, let them tell me, and then I'll see what the problem is. I'm not dismissing the question, I'm just telling you that I don't know what this is news to me, as we say in Kenya. So let the banks tell me what is it that they have a problem with, and then we'll deal with this. But in terms of checking of products, we have followed exactly the procedures we've had before. We are required as a regulator to sign off on various products for many reasons. And yes, many things require a bit of testing. One of the concerns that we have had is let's say, and somebody talked about, I think it's Duncan who talked about the digital sort of platforms that are out there, or digital products and things like that. And we have seen that they need a lot more checking. I mean, because of the embedded risks, and we need to be clear, and the banks need to be clear that those risks have been dealt with in a particular way. So I hope that doesn't qualify as a delay, right? So it's really an issue of making sure that the review of the product is done in a way that commensurates with the risks that product brings. And the product is tightened to minimize those risks. Faizo was asking again about whether the delay so far what our approach is. Do we have that sense of urgency in terms of the new currency and things like that? I don't think I can say that we can be more anxious or show more urgency. It's not like we can do that. As I said, and as was indicated in the press release, we are proceeding with all due haste. And that's all we can say, because we are going at full speed ahead in that sense. What happened and explanations of what happened in the past, that's for the historians to deal with. We have, hapa ni kazi tu. Let's do the work. Then there was a question about money supply. I don't know. I mean, I can tell you about, maybe the thing to mention there is an element here, which is an element of the private sector credit growth. That is, I think, the one that I would want to flag. That to to October, I believe it is. Yeah, October. Private sector credit growth was 4.4%. So that is the 12-month growth rate to October. And this is obviously, it's still low. But again, it's beginning, it's moving in the right direction. So the needle is rising, if you want to think of that. The needle is rising. It hasn't quite gotten where we really would want it to be. Our target for the year was actually 7%. I'm not sure if it is 7 or 8, but in any event, 7, I believe it is 7, but it was 7 or 8% in terms of growth, the 12-month growth to December. It looks like we'll be below that because we had 4.4 in October. I still don't know what it will be in November and December. But I think the point here is that that is a significant number to watch. To complete the picture, it isn't just the overall number that is, I think I should be looking at you, Duncan. You asked the question. It's not just the overall picture, or rather the overall growth that is significant. or that we are interested in. Also where it is happening, which sectors. And this is where I think we have been more, things have worked a little better, because in this we've seen that the growth has been strongest, for instance, to manufacturing, business services, finance and insurance, and indeed building and construction. Those are significant sectors. They are robust and they are significant in the economy. You could ask why agriculture isn't one of the ones that, and again, we've made the point that agriculture, despite being 25% of the economy, it probably gets less than 5% of the credit. And that's something we need to work on, to deliver credit. After all, 70% of our population are dependent on agriculture. So it is important for us to make sure that agriculture, let's say, becomes less of a becomes much more embedded in the larger economy. I think that was it. Or you had a question? Was there a question I missed? Yeah, the business models you're talking about. This is actually, well, it's an interesting question. The issue for us is the business model isn't just switching to digital platforms. That is where I want to start. When we began pushing the banks in the, as we called it, the new normal, to improve their business models, the point for us was they needed to be more resilient. So it wasn't just efficiency and things like that. It was more to become efficient, to become resilient. So you could think of, for instance, a bank that was only in the sector, I don't know, trade, or for that matter, think of an institution that is only in one other sector, not so much agriculture, but anyway, whatever the other sector is. So the point is, to be more resilient, it needs to diversify a little more, because trade can go up and down. Think of, this isn't the case. We didn't have any banks that were only concentrated in tourism. But you can imagine what would have happened if you had a bank that was more dependent, much more dependent on tourism. When tourism went to zero, that bank would have gone under. And this, by the way, is the experience of banks around the world. And a key element there was the banks, for instance, in Texas. When the oil sector went down, those banks were under pressure. So it's something that is clear to all of us. So being resilient is really the objective, not the product. How you get to the product is a second issue. The other area about resilience and improving business models is the point we've made about customer centricity. That is essential. These are the big pieces before they tell you that we have a new app, that you can use. So how are they relating to the customer? And how is that interaction? Am I the one that, I as a customer, am I the one that they care about? Or are they more interested in my deposit or my, the income stream from my interaction with them? Those are the fundamental questions that we need to think of. Of course, the other things in terms of strengthening the business model, the governance, we talked about that before. So those are much more fundamental before talking of the product. The product is just one of many. And frankly, some products work, and then they have to be, and then they can be improved. And others, at times, they are flop. I mean, you cannot always, you don't know for sure whether it is going to pass the customer interest test. As I finish, the main point still has to be the banks have to be customer-centric, and they have to be solving problems of the customer, not solving a boardroom problem, whatever the boardroom problem is. And it's great to have a brilliant product that is shiny, that has all sorts of bells and whistles, but if that doesn't resolve the problems of the customer, then it's a waste of time. Thank you, Duncan. Thank you, everybody.
All right, I think that is it. Please note the governor said you should keep the money in your source. We shall ask you to please remain in the room with the governor, the deputy governor, and the other members of the MPC. And as usual, there's refreshments down the corridor, and Mercy will be passing around these documents that you guys usually have. Anything else, as usual, can speak after this. Thank you very much, Governor.
Thank you.